When I say 20% of the market cap is driven by credit card business, probably I'm being conservative. Probably more. How does credit card make money? Annual fees, joining fees. But the greatest, greater than 50% of the amount of advertising that is happening for unsecured loans. You open TV, the number of advertisements of fintechs and NBFCs who do high price unsecured loans is ridiculously high. Right? Look at the number of people who carry an iPhone in India now. People are just spending more money.
Hey folks, I'm Edul Patel, co-founder and CEO of Mudrex, and thanks a lot for joining on the show again. Today we've got Nitin Gupta with us. Nitin is the founder and CEO of Uni Cards, and that is his latest venture. He's been a serial entrepreneur, done and probably the grand idea of a lot of fintech in India, starting off with Coach Guru and then PayU and then Ola Financial Services and now Uni. Nitin, welcome to the show.
Thank you, Edul. Thank you for having me.
No, it's a pleasure. And I would just so that all of us get comfortable and on the same page, I would love for us to start off by you telling us your journey till uni. How did all of this evolve? You've got over 15, 16 years of experience just building out a bunch of things now. So
I'm an old person.
not at all. Not at all.
If I go back, I graduated from IIT Delhi in 04, then I went to Ahmedabad in from 04 to 06. And in the summers of Ahmedabad, I had a pre-placement offer from Lehman, and that's how I ended up at Lehman.
Yeah, Lehman was likely the most coveted,
one
of the most coveted jobs that people could get, right?
Back then, yes. So 06, I started my career with Lehman in London, and they had this rotation thing, right, where you go across many desks to see which one you like the most. And the one I liked the most was the securitization desk.
Okay.
Right? And if you remember the 2008 crisis, it happened because of securitization. So my claim to fame in Lehman is that I securitized the most toxic asset in the history of UK, a pool of free performing credit card loans. I pulled out a AAA tranche, rated AAA both by S&P and Moody's, first of its kind deal, right? So did a lot of those things. I was an associate, right? So I didn't realize what I was doing.
Correct.
But now in hindsight, I can understand that how one thing led to the other. Anyway, so that was Lehman. With Lehman, I moved back to India as an expat. So that was nice. I was getting paid in pound and spending in INR. And then Lehman went belly up in 2008. September 2008. When that happened, Nomura took over all assets, and assets meant people back then, particularly in Europe. And I was a European asset, right? So Nomura made me an offer as well, but I think by that time, I was done with
enough
banking.
Securitization and toxic loan creation.
Yeah, actually I'd moved to fixed income. There was no toxic loan creation asset, but I'd moved to fixed income, more broader asset classes, doing algorithmic based trading. But eventually I realized that this is too much of a niche for my liking. So that's how in 2008, then I started my company called Coach Guru. The seed of Coach Guru actually happened in 2006 itself, before I left for Lehman, but that's a story for some other day. So in 2008, I started Coach Guru. The first year, we would have experimented with like 9 or 10 ideas to find a PMF. We eventually found a PMF. We became a distributor of coupons, both online and offline. And back then we did like 1.5 crores in revenues. About 50% of that was EBITDA.
This is like the free charge model, right?
No.
What was free charge existing back then? I don't remember.
So free charge was distributing coupons for free.
Correct.
And doing recharge. We were not doing recharge. We were selling coupons or distribution of coupons and monetizing via marketing.
Okay.
It was a different model. And before free charge.
Yeah.
To be honest. Free charge is more 2011-ish.
Correct.
And I remember 2008-ish, 9-ish.
Yeah, because I remember when I was in college, like I said, 09, 010, तो recharge करते थे और जा बस to collect those Domino's के coupons.
मैं recharge नहीं करता था.
Correct.
But anyway, so profitable companies, we eventually sold it. But it wasn't scaling the way, and back then VC ecosystem was very, very
early,
nascent. In 2011, when I was getting out of Coach Guru, I knew folks at Naspers as well. Naspers used to run Go IBO and traders, and I used to distribute a lot of coupons for them and make a lot of money off them. So I ended up reaching out to Naspers folks, and I said, you know what, I'm really good at running a business. Do you have an idea? They pitched me about half a dozen ideas. One of that was payments. And at that point of time, I felt, B2B payments will take off. We were a CC Avenue customer back then in in Khoj Guru, and we had a hard time getting that payment gateway.
Correct.
We realized maybe there are easier, you can do much more, right? And e-commerce was taking off. That's how I ended up starting PayU. When I started PayU, I had got like $500,000, and my head of operations, Shalaz, and that's how I started it. I got in 4 engineers. I was the product manager. There was an outsourced designer with a very limited small team. 3 months later, we had a working payment gateway, and we launched it in the market.
Excellent.
When we launched it, I went to Naspers and I said, you know what, give me the Go Ibibo traffic.
Yeah.
They said, prove it elsewhere, then you'll get the Go Ibibo traffic. So, and lo and behold, one of my earliest customers was Zomato. Dipinder is a old friend. And to Dipinder, I think that point of time it was called Foodie Bay. And he said, you know what, take my traffic. I'm going to sell New Year tickets this time. This is 2011.
Wait, that's what I was thinking. At that time, Zomato wasn't selling anything,
Yeah,
right? It was just a listing.
Yeah, it sold New Year event tickets at that time, and you know they grew during the New Year, and we grew along with them. This is 2011 December.
Excellent.
Anyway, long story short, so PayU went from strength to strength, right? From zero to like processing, I think, like 400 crores in the first year or something. First half year, then 900 crores, then like 4,700 crores, then 12,200 crores, then 23,000 crores, right? 5 years down the line, when we started, we were the number 14th entrant. 5 years down the line, we were number 2, behind BillDesk, and growing exceptionally well.
Correct.
That's when Naspers and I had a falling out. I had a different view on how the business should be run, what the strategy should be. They had a different view, and we kind of separated our ways. That's just 2016 late. Then I kind of took a break, reevaluated what I want to be, who I want to be. Do I want to be an investor? Every entrepreneur, when they get out after their first stint, they think investing side is very cool, right? So I did evaluate investing side, realized I like to be in the ring.
We are builders.
I'm a builder, and I also realized that what I'm excited about is the size of the outcome. That's how I ended up pitching to Bhavesh at Ola. You know what, give me Ola Money wallet, I'll build this into Ola Financial Services. There's distribution of customers, there's distribution of drivers. I can partner with bunch of people, financial institutions, and create like dozens of products. With that thesis, I went into Ola Financial Services, tried that out. Launched like a dozen products in partnership for drivers or for customers. And actually in the end, I realized that if you're building an innovative product, the distribution of your own distribution is actually a constraint. So if you're building a commodity product and you have distribution, it's fantastic. You have lower customer acquisition cost on a commodity product.
Correct.
But if you're doing innovation, your own base actually becomes a constraint because there's a much larger audience outside that base.
And you have to create the market, which is expensive also.
Yeah. So anyway, then long story short, 2020 COVID happened, and it kind of made me take a step back and think, do I really want to build it here? Do I want to go outside and build a company in my own image? All said and done, Ola Financial Services was still Ola, right? And whatever I tried to create out of Ola Financial Services, eventually it would happen in Bhavesh's image and not mine.
Correct.
And that's how Uni happened. We were very lucky to get Lightspeed as a first backer. And after Lightspeed, it was Excel. Lightspeed mein Bejul and I go back more than a decade, and I can't thank him enough. Peak of COVID-1, wave 1, and he comes and backs me fully. That's how Uni starts. And yeah, you asked the journey until Uni,
Yeah.
That's a long and short of it.
So excellent. Was the thought of Uni that you wanted to do something in financial services, like early on, like in a couple of specific sectors? Or were you saying, okay, we'll start with this specific thing and then expand like this? How were you thinking about your early launch strategy, let's say?
So the idea of 3 EMI or pay 1/3 was very clear. So that was my go-to market. So there are 2 or 3 fundamental questions to answer here. Right? The first question is, what is core thesis of Uni? When we build a seed deck, right? What did I present?
Yeah.
What was the core thesis?
Exactly. What was the pitch?
And the second thing is, what was the go-to market for Uni? When Uni started, we were mesmerized by the credit card industry. I have done credit cards. This is my 5th attempt now. But I've been trying to do credit card business since late 2015. I did it in PayU first time, but then I exited, then the project got shut off. I did it twice in Ola, one a co-brand credit card with SBI, and then a BNPL card. We had our own PPL license and a postpaid line. We combined that in Ola Financial Services to create a card. Then when I launched Uni, we first built a BNPL card. I'll talk about it in a minute. And then now the co-brand credit card. So I've been after credit card business for a long time. When we started, right, we said our focus is consumer lending and credit card business. Credit card is a very amazing product in consumer lending. It gives a lot to the customers, right? From one end rewards to short-term credit to long-term credit to a way of showcasing your entitlement in some ways, right? I have a metal
status
card, status symbol. So we said credit card, and credit card was a single APR product in market, right? 42% flat APR in India.
Correct.
Limited audience had it, about 35 million customers then. And we said this is very similar to how the US market was in late 80s.
Correct.
And what changed the market was entry of Capital One, which had a very data-first approach.
Okay.
And when they used data, they were able to change APRs, change rewards, treat every customer segment differently, and do different things for different customer segments.
Correct.
So our first part of a thesis was that you use huge amounts of data to differentiate between customer segments to have different offerings for that customer segment.
Correct. Tier, like standard tiering.
Tiering is one way, but if you look at a credit card, right, period of credit, nobody had used that as a variable to price a customer segment. We said give longer period of credit to the best customer segment.
To people who are more credit worthy.
More credit worthy, right? And even in credit card, there are 100 customers in credit card, only the top 40 are super prime. They're more credit worthy than the next 30, and that next 30 is more credit worthy than the last 30.
Correct.
Right? So you can tier even there. So our first thesis was how to use data to improve the product offering for the customer itself, right? For different types of customer segments. And price, credit period, these are just two variables. You can have dozens of variables,
Correct.
reward, etc. Our second and more fundamental thesis was that you can actually build new products. You can look at a customer segment. So verticalization of customer segment is what I call this. You can look at a customer segment which has more different needs than everybody else.
Yeah.
But they're adapting themselves to use a particular product.
Yeah.
Now take this customer segment, which is, let's say, for example, a very high quality customer segment going through short-term cash flow issues. This is a customer segment. Can you build a better product for them? This means innovation in the world of financial services.
Correct.
To do this innovation, you have to comply with the guidelines, but more importantly, you are building new underlying infrastructure like new LMS. You're combining 2-3 financial products, or you're combining 2-3 different financial models. Right?
Correct.
Last time an innovation like this happened in the world of credit was by Bajaj Finance when they invented BNPL way back in 2008.
Correct.
Right? The 0% EMI.
Yeah.
So you can do that, you can invent. So our second thesis was, how can we invent, verticalize, find new customer segments, build new financial products for them, and do this at scale. So keep finding a new segment, keep building a new product, and keep doing this repeatedly so that you can manage multiple financial products, each getting to a different customer segment and each more relevant for a customer segment.
Correct.
So that was the second core thesis. A third thesis was a corollary of this. If you can build more relevant financial product for a customer segment, digital marketing will work.
Correct.
Right? So these were our underlying thesis, and our go-to market here was the Pay 1/3 card. Now, Pay 1/3 card was a combination of a BNPL line with a prepaid card, where we said on a Visa card. See, until now, 0% 3 EMI was working on specific merchants.
Basically, you go buy a refrigerator, you get the...
On specific merchants. 100,000 merchants, right? But a Visa card works at like 6-7 million outlets.
Yeah.
How do you make 0% 3 EMI available everywhere? So we said, there is a Visa card, you swipe it. Whatever transaction you're doing, you pay 1/3 in month 1, 1/3 in month 2, 1/3 in month 3, so 0% 3 EMI or pay in 3. Or if you chose to pay the entire thing end of month 1, like a typical credit card, you will get 1% back.
Correct.
So we made 1% reward and paying in 3 months tradable for free. And this was meant only for the top 40% of credit card customers, the best risk customers, right? So this is, all our thesis came into play. We created a new product and we solved a specific problem for a customer segment using data. Right?
Correct.
Instant product market fit, this product scaled extremely well, beautiful revenues, beautiful margins. Most market didn't understand this was meant only for the top 40%.
Correct.
When you give it to the next 30%, the economics don't land. So this was, so to say, our first product, our GTM product, which is part of a seed deck, and the larger thesis of Uni, which is verticalization, data first,
building products for
digital first.
Excellent. So a lot to unpack, and we'll go through all of this. But let's, focusing more on credit. Let's start off with the basics for the audience over here. What is credit, and we can probably go that far back and say, what's the difference between credit and debit? What's a credit card product look like? What are the origins, and then where does it stand now in this country?
See, I think everybody understands the difference between a credit card and a debit card, right? Debit is fundamentally you are spending from your own income.
Correct.
So let's, instead of associating a word card, credit card or debit card, just say credit
Credit
and
and
debit,
debit.
and debit is coming from your own income. Credit is somebody giving you money.
Correct.
Now, in traditional sense, right, credit products have been loans, and loans have been in traditional sense strictly a equated monthly installment.
Yeah.
मैंने लोन लिया है, हर महीने की ये EMI है.
EMI देनी है.
अब ये EMI मेरे घर के लिए हो सकती है, मेरे कार के लिए हो सकती है, मेरे बिजनेस के लिए हो सकती है, पर्सनल लोन हो सकती है, सिक्योर्ड हो सकती है, अनसिक्योर्ड हो सकती है. एंड देन देयर वाज दिस इमरजेंसी विद क्रेडिट कार्ड जहाँ पे people said, I want to make payments, and Visa Mastercard said we'll get you interchange, some part of the fee.
Yeah.
And suddenly you had advent of a product where paying or getting credit was free.
Correct.
You got that credit for up to 50 days, but it was free. That was the first evolution of credit card, and let's stick to India, right?
Yeah.
Then the second evolution of credit card was when this got married with rewards. I think one of the earliest cards was the Indian Oil Citibank credit card, where you could get points on spending the credit card, and those points you could go to an Indian Oil petrol pump and redeem and get free fuel.
Yeah.
Right. So that was the second avatar of credit card, where first you got free credit, but now along with free credit, you also got reward points.
Correct.
Then the credit card industry in India in 2005 ballooned, right? 2005 and 6, Barclays entered, Deutsche Bank entered. Everybody thought, they'll make a lot of money in India. India is the new shining star. And everybody distributed credit cards like hell. So I think in about 3 years, credit cards went from like 7 million to 21 million. The 2008 crisis happened. A lot of people lost their shirts.
Correct.
Deutsche sold their portfolio, Barclays sold their portfolio, ICICI had big losses, and HDFC Bank was a nobody. They started to now issue credit cards. That was also the advent of CICs, or your bureaus, the CRIFs
Credit
and
bureaus.
the CIBIL, credit bureaus of the world, right? So bureau-based underwriting started, and the credit card industry went from like 21 million cards to like 10 or 11 million cards in a matter of 2 years because many cards went delinquent.
Correct.
And then that industry started to grow steadily, bit by bit. As the industry grew, the first people went after was their own customers who were credit worthy, who could be given a card, but the reward stayed low.
Correct.
Then sometime in 2018, right, when everybody had built the credit card franchises slowly back to something like 30 million cards, so that 10, 11 million in 2008 or 2009, and took almost 10 years to get to 30 million, right?
Correct.
Slowly, steadily. In fact, it was about at 19, 20 million in 2014, 15. So very slow.
Very
growth.
slowly, like a very.
But then in 2018, right, everybody realized that SBI Card started making noise that they're planning an IPO.
Yeah.
And when SBI Card started making noise that they're planning an IPO, people saw that how attractive this business was.
Correct.
Typical ROA of a bank is 1.5%. Credit card was a 5, 6, 7% ROA product. So now more banks wanted to do credit cards, and every bank wanted to get more market share around credit cards.
Correct.
People realized that 20% market cap of every major bank is because of the credit cards business. That's how profitable it is. Insane. Right? So people now, to get more credit cards, started doing partnerships, co-brand partnerships. Amazon, Flipkart, Ola, Zomato, Indigo. And as these co-brand partnerships happened, they started to give more rewards, and that's when credit card rewards started to become better and improved significantly. So that has been the credit card journey. Now, in between, something very interesting happened in 2008. 2008, Bajaj Finance couldn't do credit card, but they realized, I can tie up with the merchant, get the merchant to subvent the cost of the loan, and I can give a free loan to the customer for 6 months to buy a washing machine. That was the advent of BNPL, or 0% EMI, 6-month EMI, 3-month EMI, 12-month EMI, right? Bajaj pioneered it. Bajaj grew it immensely. Sometime in 2014-15, banks saw it. They started to get on that bandwagon. Credit card saw it, so they started, with the help of PineLab, building that partnerships out where you could get a 0% EMI on credit card. But the third big credit product which kind of took off First was loan, second was credit card, third was the 0% EMI. And when this happened in sometime around 16, 17, 18, people said, BNPL exists physically in India, let me create a digital version of it. And that's how you saw the advent of digital BNPL companies.
Yeah.
That business model never worked.
Yeah.
Globally, you saw advent of BNPL as well. So those have been the three fundamental credit products, so to say. The EMI, against secured, unsecured loan, the credit card, and the 0% EMI, fundamentally. But credit has more to offer, and that's what Uni believes in.
Of course,
Yeah.
of course. So let's actually unpack. We discussed a bit how profitable the entire credit card business is. Let's talk about the business model. Let's talk about the fees. How does all of it work?
How does credit card make money?
Yeah. How does basically credit card make money for the company, for the bank, for that matter, or for that matter for Uni?
Yeah. So credit card has fundamentally three sources of revenue. Right. One is the interchange.
Yeah.
So when you swipe your card, the merchant pays a fee to the acquirer pays to the issuer.
Yeah.
And this is all facilitated by Visa, MasterCard. That's a fixed fee you get, right? That's about 1.3 odd percent. This 1.3 odd percent would fund the free credit period, the rewards, but now sometimes, most of the times, rewards and cost of funds exceed this 1.3%.
Correct.
The second source of income for a bank comes from event-based fees. So events are annual fees, or joining fees, or when you're traveling outside India, FX fees, or when you draw more than your limit, over limit fees, or when you draw money into your bank account or ATM, then ATM fees. Now, if you kind of use rent, there is a surcharge involved, etc. Right? All these event-based fees. This event-based fees is also varies from bank to bank, but can add up to 1% in income. And I'm talking about spends here.
Correct.
Yeah? But the greater than 50% of the income is interest income. Now, in that is interest income, there are two large pools. One is called the revolve pool. Month end comes, you can't pay the entire amount of money, and you say, okay, I'll pay the minimum due, and whatever is left, you pay 42% APR on it. And whatever is left, if you do another transaction, on that transaction too, you pay 42% from day one, right? So now you're stuck with a credit card. You have done expenses on it, you can't pay back the bill, and whatever you haven't paid back, you pay 42%. This is juicy.
Correct.
This forms 60-70% of the interest income. And the remaining 30-40% is EMIs. Now, EMIs are again in two forms. Customers who find 42% expensive over time are offered a cheaper EMI. You can convert a transaction into EMI, you can convert your bill into EMI at 18, 20, 16, 17%.
Correct.
And that's one source of income. The second is you can take a loan up to your line limit at 16, 17, 20%, and that becomes the second source of EMI income. A third is 0% EMIs, the smallest of the pool, but you go buy a refrigerator at Chroma, you can take a 0% EMI from Bajaj Finance, or you can also take a 0% EMI from your credit card. So this interest income becomes a greater than 50% of your overall source of income. So these are the sources of income. Now let's look at expenses very quickly, right? So cost of funds and rewards. Usually interchange doesn't cover it, but interchange plus fees typically covers these two costs and some losses on the transactors.
Okay.
So transactors are those people who don't revolve, right? So transactors barely make money. Sometimes they are at a loss. People who use EMI but don't revolve make some money, but not a whole lot. But people who revolve make shitloads of money.
Correct.
So in this business, you don't know upfront who's going to revolve.
Correct.
But whoever revolves makes you shitloads of money.
So what's the share like of these revolving customers versus just the transactors? Like
so
the guys who don't.
So instead of a user level, let me give you a balanced view. Right? If 100 rupees is outstanding in credit card receivables for a bank, before COVID, about 40% odd, 42% used to be revolve balance. That 42 has now come down to 25%. Okay. So if 100 rupees is outstanding, 25% will be revolve balance. Another 35 to 40 rupees will be EMI balances.
Okay.
Right? And the remaining 35-40 rupees is your non-interest bearing balances that the customer is in the credit-free interest period. So this is the broad breakup in terms of balances.
Correct.
In terms of customers, of course, fewer than 25% customers, about 15% customers would revolve different at different points of time, right? Overall, that number may touch 25%, but at any point of time, it will be closer to 15. From an EMI perspective, about 40% customers, between 30 and 40% customers will end up taking EMIs.
Correct.
And the remaining, about 40% customers, 30 to 40% customers will either never take a interest-bearing product or something like that.
Correct. So I've always wondered, why do credit card companies have this minimum pay amount? Like, what's the intent of that?
The minimum due amount is to get the customer do something.
Okay, is just that key?
अगर कस्टमर कुछ नहीं पे करेगा तो देखो कस्टमर को इंटरेस्ट पे करना है, फीस पे करनी है, ये तो करना ही है.
करेक्ट.
तो मिनिमम ड्यू में वो चीज होती है और थोड़ा सा प्रिंसिपल कम हो जाए, राइट. वरना तो प्रिंसिपल आउटस्टैंडिंग रहेगा, वो इंटरेस्ट फीस लगती रहेगी, फिर इंटरेस्ट और फीस पे दोबारा लग जाएगी.
करेक्ट.
तो इंटरेस्ट फीस तो उतारनी है और एक प्रिंसिपल को कम करना है. करेक्ट. राइट. सो दैट इट एंड्स एट सम पॉइंट. दैट्स द आइडिया ऑफ द मिनिमम ड्यू. वरना बैंक का बस चले तो मिनिमम ड्यू को हटा ही देगा, सिर्फ इंटरेस्ट फीस देता रहेगा हर महीने. तो वो नीचे नहीं जाएगा. 42% पे अगर इतना कमाने को मिल रहा है, कौन चाहेगा कम जाए?
एग्जैक्टली, व्हिच इज द
बट फॉर इफ यू थिंक अबाउट द इंटरेस्ट ऑफ द कस्टमर, यू वांट मिनिमम ड्यू टू बी द राइट अमाउंट सो दैट द कस्टमर कैन पे इट बैक क्विकली, राइट. 42% इज एक्सपेंसिव.
करेक्ट.
कस्टमर की नीड आई है तो इसलिए पे कर रहा है. एंड दैट्स व्हाई somewhere building a better product for a higher quality credit customer was the need of the hour.
Correct.
That's why Pay 1/3 got built or Uni Paycheck got built.
Correct. So, but isn't 42% ludicrous? How is there no competition that's driving down this interest rate?
Because in India, everybody is pricing themselves at 42%.
Okay.
Now, see, the interesting thing is in US, originally it was same price with everybody at 30%.
Yeah.
But Capital One differentiated in prices. But in US, there was no personal loan product. Correct. So credit card was the only way to borrow and therefore have a differential pricing. In India, personal loan is a very big product.
Correct.
And personal loan is risk priced, right? So we can get a personal loan at 12% and 15%, 20% and 30%, 40%, depending upon the risk of the customer.
Correct.
So because personal loan exists, credit cards are not used for medium to long-term borrowings.
Correct.
It is used only for short-term borrowings. In short-term borrowing, there is no other product. In short-term borrowing, therefore, the bank says, if I'm going to earn only through this, let me earn 42%. And everybody has priced themselves at 42%.
Correct.
On EMI, if the customer is not taking that, then they've priced pretty attractively at 16 to 20%. But अगर वो customer के पास और कोई short-term product नहीं है, तो ये 42% पे यही available है.
Correct.
So that's the thinking behind it. And then every bank is used to the ROA of a credit card business, right?
Yeah.
SBI card has shown a 5.5% ROA business. Now home loans brings them 1%, less than 1%, right? Secured is like sub 1% business.
It's the drug that they are used to.
So this is the only way the bank shows a better earnings, right?
Yeah.
When I say 20% of the market cap is driven by credit card business, probably I'm being conservative.
Yeah.
It's probably more. So कहीं से तो कमाएंगे.
हाँ.
तो वो यही तरीका है. तो कस्टमर को जब प्राइस सेंसिटिव होना है तो वो पीएल ले लेता है.
करेक्ट.
और क्रेडिट कार्ड पे वो प्राइस के बारे में सोचता नहीं है एट टाइम ऑफ टेकिंग प्रोडक्ट. सो ही इज नॉट ट्रेन्ड.
Correct.
So even if you offered at 42%, said I'm 24%, the customer wouldn't take that product.
And they would. Do you think they really would care also? Because this
exactly.
Is an
so
aftershock,
customer
right?
is not taking a credit card product basis APR.
Correct.
They're taking credit card product because either because of line or access or the rewards.
Rewards or
they
status.
They are not coming with the intent of revolve.
Correct.
उनको लोन की जरूरत है तो पर्सनल लोन तो मिल ही रहा है.
करेक्ट.
तो इसलिए वहां पे ना 42 को कम करके भी कोई फायदा नहीं होता.
करेक्ट. That's not the ask.
Correct.
So then let's. Okay, of course, credit in India is growing, right? Like there is a recent report by CIBIL saying that the rapid pace of credit growth in India continues. So let's talk a bit about that. What is this growth being driven by? Is it all just consumerism and consumption? Yeah. Is it just investing in yourself and growing and improving? So, for example, are people taking more home loans, personal loans?
So if you think about it, right, there is growth across the board.
Correct.
Right. So as GDP goes up and per capita income goes up, right, people want to consume more.
Correct.
The first thing they want to do is build a house, and therefore affordable housing and all these companies are extremely well. They want to buy a car, and therefore you see auto sales up, and majority of it is funded by auto loan. But because of widespread consumerism, because of widespread consumption of digital, consumer also wants more. They want a more expensive phone, they want more expensive clothes, and they want to eat out. They want to spend more on themselves.
Correct.
And that's why you see an uptick in unsecured as well.
Correct.
Right? Now, unsecured uptick and at the same time a savings drop in India, right, is very clearly indicating that consumerism is up.
Is up.
And some consumers end up spending beyond their means, which is also what
Concerning.
causes a chaos, right?
Yeah.
Now, credit cards, so far, only banks could do credit card. Right? Banks are very conservative, right,
Yeah.
in terms of their risk underwriting. So the best customers got credit cards. But NBFCs can do loans, unsecured loans and BNPL loans, right?
Correct.
And they have more sophisticated underwriting. They're willing to take more risk. They're willing to operate at higher losses. And so for they're willing to give out loans to many more people.
Correct.
And therefore, you see a greater uptick in unsecured lending versus secured because of presence of large number of NBFCs and fintechs for that matter, and because in general consumerism is up.
Correct. So
So
digital, a lot of fintechs coming in, rise in consumerism is all that's driving this growth.
yeah,
Right?
and NBFCs being able to do digital loans while not able to do credit cards. Agar if fintechs and NBFCs could do credit cards will also
Everyone would do
explode this way.
Okay, and which sectors or which kind of people are doing? Is this urban people? Is this rural? Where is the growth happening?
Everywhere, right? Consumerism is up everywhere. So across sectors, you are seeing a growth, is what I remember.
Yeah. So the report also quotes that effectively the number of applications are so high that the rejection rate has actually gone up. You think that's because the demand is increasing but people are not there yet? Like from a
Both reasons, right? So demand is increasing and people are not there yet, or people have over leveraged themselves already.
Okay.
So both reasons exist. Earlier I didn't have a phone. Now I want a smartphone and a data connection. I want a better phone.
Correct.
Right? Look at the number of people who carry an iPhone in India now. Right?
Yeah.
People are just spending more money.
Correct.
And so rejections happen because more people think like we funded this through a loan, but they are not
The
ready
bank is not
for
willing
it, or they are already over leveraged, or they have screwed up the data, bureau data somewhere, and
Correct.
and therefore they can't qualify anymore. I think there is a third trend if I think about it. The amount of advertising that is happening for unsecured loans is also unprecedented. You open TV and like the number of advertisements of fintechs and NBFCs who do high price unsecured loans is ridiculously high. I think that's the third factor.
So then basically should we call it that there is a market creation that's happening for all of this that's causing it, or is this just?
Yeah, there was a need.
Yeah.
I want to consume more, and somebody's saying I'll give you an easy loan.
Yeah.
Right. So the ease of getting a loan means I just have to download an app, fill out the paperwork, and I may get it.
Yeah.
Right. So both help, right?
Exactly.
I have a need, and that need is arising because I consume more digital and I see more things happening around me. But also I consume and see a solution to that need, which is getting a loan, and that is also being advertised to me.
Correct.
Both kind of.
Of course, a large part of the credit, the reason why the rates are so high is because there is NPAs and there is delinquencies. So what does the delinquency stand at for, let's say, credit card companies versus a unsecured loan versus a secured, let's say, personal loan on cars or home?
Let's look at SBI cards. Right?
Okay. Yeah.
SBI cards is a 5 to 6% loss rate company.
Okay.
If you were to, but then whatever recoveries they have, they count it as revenue. Either way to look at it is to take it net off, and they become a 4% loss rate company, right? So they are losing 4% of their AUM every year roughly due to loss rates. Now, if you look at Bajaj Finance, their number is closer to 1.5%, but then they have a lot of secured as well in that book.
Correct.
If you look at more these digitally advertising fintechs who are talking about they're going to a segment which banks don't lend to. Their loss rates are north of 15%.
Correct.
So you have multiple segments going on here.
It's a huge gap, right? Like on the one end, we've got Bajaj
1.5, 4, 15. You see there is like a 3x jump each time, but yeah. So credit card is still catering to a high quality customer segment, right?
Yeah.
SBI card caters to a high quality customer segment, but credit card is a product which experiences higher losses.
Correct.
But yeah, you have all kinds of customers, right? Banks will be operating at a sub 2-3% loss rate on the unsecured book. Large NBFCs, while doing unsecured, will be slightly higher than that. Fintechs will be fintechs focusing on a customer segment which banks don't want to do.
Yeah.
Will be definitely higher.
Correct. Because there is a specific reason why the banks don't want to do it in the first place.
Yeah.
So I think let's talk a bit more now about distribution of the digital cards and of credit that you've been doing at Uni and how do you think of it, right? So what is it like now to start a credit company, let's talk about trends and who should you target if you are wanting to do it now, today, again.
See, every few years you can spot a trend, right?
Yeah.
So companies in 2017, 18, 19 who started digital lending, they found a beautiful product market fit. The product market fit was going after a customer segment which banks are not willing to cater to, charge them IRRs which are higher than 40% and operate at a 10 to 15% loss rate. All of those companies found a product market fit and are today profitable.
Yeah.
Right? But now to grow their customer base, they are resorting to TV ads. And once a fintech is doing TV ad, that means they have run out of ideas of how to get more customers.
Yeah.
The product is now become a commodity. If you are starting a new credit company today, right, you cannot ride on an idea which have existed in the past and have already been commoditized. You have to find a new problem to solve if you are starting from scratch.
Yeah.
If you're Geo Finance, then it's a different story, right?
Yeah.
You have too many advantages already. You're starting. So going back to Uni's thesis of verticalization, you have to find a customer segment. It may be retail customer segment, it may be a B2B customer segment. But that customer segment needs are not well met from existing financial products. They're adapting to the financial product instead of financial product adapting to them.
Correct.
And therefore, there's an opportunity to invent a new financial product. Now, inventing a new financial product can mean few things. It can mean improving the experience of getting the product. It helps, but now everybody gets that thesis, so it doesn't help too much. It can mean fundamentally changing the product itself. So like 0% EMI was a new type of product. So fundamentally cracking something new in that product, which changes the price of the product significantly. So suddenly loan became free in a 0% EMI,
Yeah.
right? So what if you can do something where the customer finds the price to be meaningfully lower than any other product out there, or alternatively, the customer finds the product to do different things than available otherwise. So if you look at my Pay 1/3 card, it did different things. It also improved price as a consequence. The third kind of innovation is risk-based innovation. You are able to leverage data in ways that nobody else can and therefore unlock a customer segment
That others could not.
Others could not. Now, this data could come because you designed an ecosystem around it, or you are analyzing existing data better. It could be any of those things, right? So when I look at fintech companies innovating, I see them do one of these.
Correct. Now, talking about innovation, there is this, on the regulatory side, there is this balance that needs to be there, right? About what innovation is allowed, what innovation is not allowed, what should be catered to, and so on and so forth. And in India, although we've been very progressive in general with access to fintech and so on and so forth, but innovation in credit continues to keep on changing. So let's talk a bit about the regulatory side as well, right? What have been in the past general challenges that the industry has seen, and where is the status today?
There are two perspectives here, the perspective of the regulator and the perspective of the fintech. See, at the end of the day, you have to understand that the fintech is a capitalist.
Correct.
They are bunch, not just fintech, any business is a capitalist. They are for profit. Anybody who's for profit, while they may have their own morality, putting constraints and guardrails, they are rushing to get more profits.
Correct.
Right? And in pursuit of that profit, greed for more profit, more scale, in any financial services business, contagion risk is created.
Correct.
Structural risk does get created whenever something grows very fast. You see that second order risk, third order risk after some time, but it does get created.
Correct.
The regulator's objective, if you think, is protecting the customer.
Is safeguard the common man.
Is stability and is avoiding any structural risk or reducing and mitigating structural risk, contagion risk in the ecosystem. So when fintechs come in, they're like, the only way for us to win is to innovate.
Correct.
They innovate. When they find product market fits, they start to scale very fast. And then when they start to scale, because of fear of competition, right, they put unprecedented amount of dollars into a non-proven market, and they sometimes take shortcuts.
Yeah.
When this happens, and when it's happening at a very, very fast pace, because companies can now scale very fast given digital, freedom of advertising, large capital pools, funding, all this,
Correct.
in a matter of months, which initially should take matter of years. So RBI, when they kind of see what, in 6 months, everything significantly changed, and they see this contagion risk, this structural risk, this common man getting deceived, and this common man then getting and complaining on social media, like, dude, what's happening? So the regulator then reacts. Now, sometimes that reaction, fintech doesn't industry like at all. When the loan got dropped into PPI, many fintechs cried hue and cry. But then, usually you can see such things coming. Right?
Correct.
If you interface enough with the regulator, then you can see how the regulator is thinking about these things and what are they worried about.
Correct.
One amazing thing that has happened about the regulator over the last 18 months particularly is that they have stepped up their engagement with the industry and with the fintechs significantly. They've almost 10x'd it, which means that they're telling how they think, what they're worried about, and you can ask them questions of what they're thinking and what kind of views they have around various things. At least informally, no.
Correct.
Right? So once you understand how the regulator thinks, what they want, customer protection, no structural risk or mitigation of structural risk, stability, right? So if you have found a new product and it's scaling too fast, you understand what's the structural risk and you work with RBI to solve for it. If people are taking shortcuts, you call it out, you form industry associations and SRO, self-regulatory bodies to control it. If the customer is being taken for a ride, then you come together, you educate the customer. You slow yourself down to make sure that wrong things don't happen.
Correct.
Right? So this is the evolution of the industry I see over the last 18 months. But what the regulator is doing is right.
Of course.
Right? If you look at India, when the 2008 global crisis happened, did it happen in India?
The effect was felt.
Very little. We didn't go into recession.
Yeah.
It was hardly anything. When the entire P2P crisis happened in US and China in 16-17, did we even realize it?
No.
We didn't. When the entire inflation crisis happened in 22 across the world, did it happen in India?
I don't think we even know about this.
When crypto went down in 22, 23, 22, did we even feel it? Very little.
Yeah.
What is RBI doing in each of these? The regulator is saying, you know what, I don't feel right.
Correct.
Something feels wrong. Let me put a regulation around it. Let me slow it down. Let's understand more.
Correct.
Let's actively solve for it, but let not create a structural risk.
Correct.
Right. So if you look, right, financial crisis happening across the world in one asset class or the other, and India stays protected. So the regulator is doing its job well.
Yeah, it's doing a great job.
Right? And somewhere, as I said, right, credit card has higher risk, has long-term expectations. Only banks do it. There's a reason they don't want anybody else to do it.
Correct.
So last year when RBI said, you know what, loan into PPI is not okay, it was because people had made a product which looked like a credit card.
Correct.
And were calling it a credit card for the goddamn. Right? It wasn't. ठीक है, गलत हो रहा है.
Correct.
ठीक है, रहने दो. But if you interface with the RBI, you could see it coming. You can understand what they're thinking.
Correct.
So I don't think that RBI is anti-innovation. I think they're very pro-innovation. But they don't want is innovation leading to contagion, structural risk, and the customer getting deceived. If you can solve for that well, I think all innovations will fly.
Yeah, exactly. Like they are pro-innovation as long as it's in that sandbox of making sure that things are okay.
Yeah, I mean, see, risks will arise. You have to just work with them to mitigate that risk.
Correct.
Right? But sometimes in pursuit of greed, वो गई बाद में, चलो बाद में देखेंगे, फट गया बाद में देखेंगे, वो नहीं चलता.
वही move now break.
हाँ,
check for the breaks later.
Yeah, move around and break things. Not in financial services, right? Correct. You're borrowing from NBFCs, NBFCs are borrowing from banks. Suddenly you go away. LFS kind of crisis will get created.
Correct.
Everybody is connected. So you're not operating
in silo. In that case, now let's look at what the future looks like. And दोनों perspectives से थोड़ा देखते हैं. One from the perspective of, let's say, a young fintech startup that's trying to innovate. So let's talk about what are some white spaces, some interesting ideas that you see on that front. And then let's also talk about some of the larger companies, like what is Bajaj Finserv thinking of now? 14, 15 years after they basically invented BNPL and are now probably one of the largest lenders in the country. How are they thinking of innovation? So let's talk about both of these.
So when you talk about Bajaj Finance or for that matter, Geo Financial Services or anybody else, right? Institutions like these will look what unique advantages they have, what unique capabilities they have, and how can they build on top of it. So for example, Bajaj Finance has a large balance sheet, all the advantages of a large balance sheet, a massive distribution. They are more adept at playing with technology than people of their size.
Correct.
Or plus minus. So it's more easier for them to add a new financial credit product in their portfolio than doing any other type of innovation. Right?
Correct.
So for example, loan against securities was typically loan against shares in India, a small market. But then a lot of people have mutual funds, so you can do loan against mutual funds. Then people have LIC policy and ULIPs. You can do loan against ULIPs, LIC policies, right? Bajaj Finance is somewhere the front runner. If you talk to any fintech who is doing a loan against MF product or loan against LIC product, right? You'll see Bajaj Finance as a recurring name.
Correct.
Because they are designing products, new financial products, to the kind of innovation to kind of keep building. On the other hand, if you look at a fintech, right? The only advantage that a fintech has is two. First, they can go deeper into a customer segment and find a need that nobody else has been able to spot so far.
Correct. They can start off with a very small niche.
Yes. Second is their ability to build technology. So a fintech has to marry these two.
Correct.
So the kind of innovation I see is literally new emerging business models which have not existed before. So for example, I'm an angel investor in a company called Tech. It sells commercial electric vehicles to people, right? And it's an auto, it's a small load carrying commercial vehicle, like 3, 4, 5, 6, 7 lakh rupees. It said the big cost is the battery. And people don't know how to underwrite a battery. So they said, you know what, let me create a new business model here. The vehicle without the battery is a typical loan.
Yeah.
But the battery, I am doing a different type of credit product here, which is called leasing.
Okay.
So I am buying the battery and I'm giving you the battery at pay per kilometer usage.
Excellent.
Right? New type of product in an emerging segment.
Correct.
Nobody else can spot it or build this.
Yeah.
And this is how fintechs find specific customer segments and solve their problem better than what anybody else
Correct.
can.
This was exactly the point that you were talking about earlier, right? That verticalization of the problem statement.
Correct.
Very interesting. So let's now, because you spoke about your, with your tech, you've not only invested there, but in a plethora of other angel investments in a plethora of other companies as well, right? So how has that been like? Like when did that start? What does the scope look like today? What are some of the most exciting fields and theses that you have built that you want to invest in the future?
So I started investing in early 2015.
Yeah.
Some opportunities came my way because of, I think, people saw PayU being relatively successful. At that point in time, whichever entrepreneur you would talk to, hey, amazing guy, will build something, right? So first set of my checks went in to almost 100% of the opportunities I came across.
Yeah.
And when I left PayU, I thought I'll become an investor. So I started applying a little bit more discretion to where I should invest or not. But most companies I liked, so I kind of again invested quite a bit in variety of companies. But then over time, I have evolved to a point where my investment thesis are twofold. Either I've known the founder for long enough time and I respect the founder. In that case, I don't care about the idea of the thesis. I'm just backing the founder for whatever they do. The second is financial services, fintech. I love that space. I invest public markets, private markets. I am a practitioner myself. So I have more grasp usually of the thesis. So when I see a thesis and I see merit in that thesis and I see a founder worthy pursuing that thesis, it's a very quick decision for me.
Correct.
So today I'll have more than, 60 active investments. I would have exited from more than a dozen investments. So total overall, I would have 75 plus investments. But if you look at my investments over the last 3 years, roughly 50 to 60% will be financial services, and 40 to 50% will be founders who I knew from the past. A small chunk from there, 5% will be founders, where in the first conversation I was so impressed by the founder that despite the thesis not being financial services or me not believing in the thesis, I ended up investing in the founder.
it.
So that's my large
So
approach.
YC does something called as a request for startups, right? Where they put out a list of ideas that are interesting for them. Any such request that you have, let's say problems that you think are obvious that you would have spent time solving, but you think, but you're of course too occupied with what you're doing.
So one of the things that I'm waiting for to happen, right? Many people have tried building personal finance management on top of SMSs and emails.
Yeah.
But the quality of underlying data is poor and has noise.
Very bad. I've not seen one good.
But now, due to account aggregator, and the access to data has become excellent. I'm waiting for somebody to crack a beautiful personal finance solution on top of account aggregator.
Yeah.
It's a matter of time before the large payment guys do it.
Correct.
But I'm hoping a startup will beat them to it with a more exciting product. So that's one thing where I'm saying, it will happen. Account aggregator has brought beautiful data to the fold. You just have to now apply.
It's not yet all open, right? Like right now, just the banks have started to share.
But that's a very rich data, your bank account data, right? You connect all the bank households data, right? Me, my wife, whatever I want. And now a layer on top of this, and you suddenly have such a beautiful personal finance management on top of your household bank accounts.
Basically, family finance.
Family finance, individual finance, right? All of this, personal finance management. The quality of data is rich. Both you and your spouse can contribute to it. Whatever, right? So there is like immense opportunity there.
Yeah.
And multiple types of use cases will emerge. Use cases or whatever, right? There will be an individual. There will be individual living with friends. There will be a family. All of those things, use cases.
There are a wide variety of those.
Personal finance management. But yeah, that's one area that I'm extremely bullish on. And similarly, right, there are just way too many. I think the number of white spaces that fundamentally exist in financial services.
Because we're talking about finance, let's also quickly jump into Uni is now starting to do something on wealth. Do you want to talk about that a bit?
So Uni has a large lending business. It's led by a product called Paycheck. And we have an NBFC P2P license, and large part of a lending business is funded by P2P. Now, when a investor invests in P2P, right? They usually are chasing slightly higher returns, and it's a way of diversification in their portfolio, right? They're already a mutual fund investor, maybe have some stocks, have some FDs, have some all of those things, and they're saying, let me add a little bit of P2P as well to generate slightly higher returns, right? Now we are already getting a lot of such customers to fund our lending business. Now we have those customers, right? So there's an opportunity to build more for them, because these are anyway wealthier customers. So that's why Uni is heading in that direction. Also in that direction. So we have three fundamental businesses. One is a large lending business led by Paycheck. One is our wealth business, which is today led by our P2P investment product. It's called Power Up by Uni. And third is our credit cards business, which just started.
Yeah. So is this, this entire account aggregator coming in, generally finance exploding in the country with everyone wanting to get you to invest in mutual funds, individual products, FDs, gold, and so on and so forth. Do you think that's like the next large wave that's coming in?
Yeah, so in wealth, right, I think there are two fundamental opportunities. The first opportunity is being product-led.
Correct.
So we are P2P-led, stable money is FD-led, Vint is high income, high yield bonds-led, Giraffe is something similar, right? So you can take a very product-first approach in wealth. If you look at Deserve, for example, the PMS is excellent. It's a mutual fund-based PMS. They're saying,
Correct.
In a profit-sharing model. So people have become very product-first from a portfolio-first approach. All the wealth startups which came in 2015, 16, 17, 18 were like, let me manage your entire portfolio.
Correct.
To a point where people are saying, I have an excellent product. Take that product, and by the way, I'll do more for you. And so this product-first approach, wealth thesis works very well. at least half a dozen examples out there where each of them are pursuing a unique
one individual product strategy.
yeah, even grip for that matter, right? The second thesis is that as disposable income is rising in India, people with wealth are increasing. Investable assets are increasing outside real estate, right? But the wealth managers are not increasing at the same pace. Because people who are richer are also getting richer and they still cater to them.
Yeah.
So there is this white space where people with, let's say, up to 50 lakhs or 1 crore, 1.5 crores of investable assets, they're not investing themselves. Thanks to Grow and Coin and many zero cost mutual fund platforms or direct mutual fund platforms, people are buying mutual fund themselves, people are buying stock themselves, people are doing variety of things themselves. They're investing in Vint or Grip or stable money or Power Up or many of these things, right? So there's an opportunity to be a wealth manager for these people.
Correct.
But you can't afford an expensive wealth manager, so how do you leverage technology to do more for them? Right? There's an opportunity.
Yeah, and wealth is also such a personal problem, right? Like
exactly.
The solution for you versus for me versus for all the other people in the audience is so different.
Correct.
That it needs to be personalized, and that solving personalization at scale, I think, is the problem.
Extremely hard.
Yeah, it's of
right?
course.
It doesn't get solved.
You can't standardize wealth.
So what do you do,
everyone.
right? So there's an opportunity.
Yeah.
I'm not necessarily calling out a solution there. I'm saying there's an opportunity.
Yeah.
Is it personal finance management first? Is it a product first thesis? Is it something else? A tele-based RM first thesis, right? There are multiple approaches to this problem, second problem. And the first one is definitely very exciting, which is a specific product to get a customer in because it's exciting for them.
Yeah, excellent. Let's now move towards a bunch of other regulatory changes that are happening in the country that I think are also interesting that are going up. So what's your thoughts about this marriage of credit and UPI that's coming up?
So credit on UPI, I'm still not clear on the interchange that NPCI is giving on that product.
Yeah.
But if you think about it, right, assuming there is healthy interchange as much as what a credit card gets, then suddenly credit card is a very straight-jacketed product, right? A lot of regulations, a lot of rules.
Yeah.
But credit on UPI is free.
Correct.
Free from any regulatory straight-jacketing today. Right? It will get there, but today it's like the amount of innovation that can therefore happen is huge. A credit card has to work in a certain way. Credit on UPI can work in any way. So innovation scope is very high.
Correct.
And as people will try different things, they'll find product market fit at some places, they'll scale that, and that's when the regulation will start to remove the risk, the structural risk, making sure the customer is protected, all of those things. But today there is no straight-jacketing. There is no constraints. It's beautiful.
Yeah, so
very,
the scope is immense
huge.
of credit on UPI.
Yeah.
So do you think it'll, like right now, the way they are setting it up is that you have a RuPay credit card that you link with your UPI and do it. Do you think it's going to expand that way?
The customer wants to pay via UPI. They find it more convenient.
Exactly.
Right? But there are 2-3 more things involved for the customer or for the ecosystem, right? For the merchant, until now, UPI was free. Now suddenly they're paying a charge and they're like, how do I reconcile this? Right? So that's a reconciliation problem in the mind of all merchants. They would prefer it to be free, and if the customer wants to pay through convenience, UPI, let it be free.
Correct.
That's one big problem. The second problem is for the issuer itself, right? Because transactions under $2,000 are free, they're not getting interchange for it, so they have to pay from their pocket, at least the cost of funding it, the cost of credit. And now suddenly the P&L looks worse. What do you do? So there will be an evolution to a point where the merchants will find it okay, some may say no, some may say yes, the P&Ls will evolve, the customer will evolve, and therefore a new PMF will be found here, but there is interest for sure, right? The customer is excited. Most banks are issuing 2 cards, one physical, one virtual one works on UPI, common line.
Correct.
We'll see, right? But there is interest, but there's some unsolved problems which will get solved in the short term. It won't take too long. So that's my view on.
Excellent. So let's. I think we've covered a very, very large breadth today. Let's actually wrap up by talking a bit more about how personally you live life and so on and so forth.
Okay.
We've touched upon some of your angel investments. How do you manage your wealth? What does your portfolio look like?
So I'm a equity investor. So I believe that wealth can be created by owning a piece of the business.
Yeah.
Early stage investments are either done myself or I'm a LP in few funds. Then in late stage private, again, there are ways to access, you can put money behind some growth funds. Public markets is through PMS, through mutual funds, and my own
Pick and choose.
pick and choose. But I only invest in equity markets,
Correct.
apart from Power Up.
Yeah. Do you think in general in India, like the risk appetite is increasing for people to invest? Like for example, at Mudrex, we see people starting to pick up and invest in alternate asset classes like crypto. Small amounts, but that thought process is just generally growing. You think that's happening because of access?
For sure. So I think there are 2 or 3 factors which get people to take more risk. First, the generation before us, the kind of India they saw, they were more conservative. Our generation, because our parents are now fine, we are earning well, we are willing to take more risk as a generation. Right? It's both exposure internationally, it's also the status of India and the stature of India. Second is just presence of more disposable assets. So you have far more people doing that. Third is the upside of opportunities. Right? So people who did a lot of crypto in 21, 22 were chasing extraordinary returns.
You remember the IPL 300% return ads.
Than any other asset class could offer, right? So there are people who are saying, I have a larger risk appetite, but I also want to earn faster. Can I take more risk and get higher upside?
Correct.
So I think those are the set
Broad
of
buckets.
things, broad buckets, but you have, because India is huge, right? You have distribution among all and you see growth everywhere. But newer asset classes are growing because they're offering more to a customer than what a traditional asset class could.
Got it. Okay. Let's do some rapid fire now.
Okay.
So let's say one movie or TV show that you are now looking at watching or have recently seen that you really like and enjoyed.
A show I recently recommended to someone, which I obviously enjoyed watching, was Sanctuary on Netflix.
Okay.
It's on sumo wrestling, and the delinquent teenager, the bully, and his transformation but has potential. His transformation from that kind of personality sumo wrestler to a very mature sumo wrestler. I strongly recommend it. If you like sumo wrestling or if you have any interest in sumo wrestling, great story to watch.
Nice, excellent. Some books, some of your favorite books of all time, and of course books that you're reading right now. And you can also extend this to books, podcasts, general learning sources.
So I believe that life has to be lived by a philosophy, and you have to embrace some philosophy in life to set principles of living and derive happiness. Gita is one way of living, Buddhism is one way of living, Brahma Kumari is one way of living, Stoicism is another way of living. This book called Little Book of Stoicism, so I believe they're very similar principles, similar teachings. So one of the books that I have gifted to a lot of people is called Little Book of Stoicism, which is around.
I've heard quite a bit about that book, and I've been wanting to read it. It's in there in my list.
So that's one. Another book that I recommend to a lot of people is called Influence. I think the number of principles it has, it's the art and science of persuasion, more science. Amazingly good, which has a lot of lessons on how to be better at business development and sales.
Just a better salesperson. Like Influence is the number one book that I've gifted to people in my team. Like it's by default the book that I share across. It's like also, I think probably for me, the book that I've reread the most.
Yeah, it's quite amazing.
Yeah.
I read a lot. Like I'll do like 20-30 books a year.
So what's the top book that you're reading right now? That's your favorite?
So I like reading a little bit of biology and human body. So I'm reading Models of the Mind. It's the engineering, mathematics, and physics or science of the brain.
Yeah.
And in parallel, I'm doing a light reading with a book called Hidden Potential. I think it's by add him something, it's about how do you grow? How do you grow faster? How do you learn more? How do you become better? And probably so much better that you are the, like literally the
The best.
outlier. How do you get there? Right. So those two books in parallel.
Correct. So then one purchase that you would have done recently of, let's say, under 10 odd K that you think is meaningfully changing your life.
Meaningfully changing my life.
Just or gives you those joys on a regular basis.
Books give me joy. So
Yeah.
regular purchase of books. I think the money I spend a lot of money on
I think the
on
stoic
books.
in you is clearly visible there. So Nitin, of course, running a company at the scale of Uni is hard. You're running 3 businesses inside, right? How do you balance that with your personal life? And maybe we can also touch upon how does your day look like to also, so that people can empathize कि चल क्या रहा है.
First of all, I think the first thing that you need is a very amazing spouse who gets you. like चल ठीक है
Brownie points
तू
for
जी
home
ले
today.
अपनी जिंदगी. uh, the second thing is you need amazing co-founders and senior team who is as strong as you and can run the business with or without you the same way. जब ये दो चीज़ें ट्रू आती हैं तो अपने आप वर्क लाइफ बैलेंस इमर्ज कर जाता है बड़ी प्यार से. However, there are times when work-life balance goes for a toss. When the company is going through a problem statement which only you can solve best. And then your work weeks are no more 50, 60 hour work weeks, but 80 to 100 hour work weeks.
Correct.
And weeks at stretch. तब सब चीज़ें फट जाती हैं. But otherwise, I'm a big believer of a 5+2 working philosophy, which is working 5 work weekdays and not working weekends. And in those weekdays, do 50 hours of work, do 60 hours of work, whatever is needed, but wrap it up
In the week.
those 5 days. So that kind of works appropriately for me. You also get to points where you have routines or you have invented small routines, which makes sure that you are meaningfully present in the lives of the people that you want to be present in.
Although it answers the first part of the question.
The
Let's talk about the second part. Let's talk about the routines in your personal day.
So I'm a big believer that any senior team should half their calendar free, which is day after tomorrow or 2 days from now.
Okay.
Which means their scheduled meetings needs to be extremely low.
Okay.
The charters can be as large as they want, but the scheduled meetings should be extremely low, which means they're not the bottleneck for decision making then. And in turn, that team is extremely strong to make things happen. And the relationship between two team members is strong enough to resolve differences.
Correct.
Right? So when a leader gets to a point where day after tomorrow or 2 days from now, the calendar is greater than 50% free, 60% free, 70% free, that's the ideal point to get to. For me, Tuesdays are my travel days. So Tuesday there are some meetings with partners which I schedule myself. So I don't use an EA. I schedule my own meetings for Tuesdays, or any meeting for that matter.
Yeah.
Wednesdays I have all my pre-scheduled meetings, and half of them are one-on-ones.
Yeah.
Thursdays evenings are leadership team catch up, town hall, and once a month I review functions and businesses which are called monthly deep dive. So that gets scheduled on Thursdays as well. So Tuesdays, Wednesdays, Thursdays are gone this way, but not all Thursdays. Some of them
is extensive.
1, sometimes 2, and not all Tuesdays because there might be a Tuesday in a month when I might not travel.
Yeah.
Mondays and Fridays are all ad hoc days, right? And there's enough space left. So this is what it is. Now, if you look at my calendar for any day, it will get jam-packed. It will get jam-packed only a day before.
Okay.
So when somebody needs time, it's right there.
It's
Available.
always just 1 or 2 days away.
It's always available.
Yeah.
Right? Typically not 2 days, 1 day only.
Yeah.
It's always available. So there are things where people need your opinion, or people want you to kind of look at something or do something, or there's something urgent. Right? That time is always available.
Yeah.
So my next day calendar gets filled in today. But if you looked at my calendar 2 days ago, it will be greater than 50%, 60%, 70% free.
So how do you manage your task list? Is this on the calendar, on a notes app? Like what's that hack
Yeah,
that you
so
use?
I use 3 apps excessively. Calendar app. So I manage my own calendar, so I know what's important, what's not important,
Correct.
when to put things, how to reschedule. So nobody else controls my time but me. Small tasks goes on my to-do app. So I would keep. Uh, Earlier I used to look at my to-do app every day. Now I look at it twice a week. That's much better.
Yeah.
And then there's a notes app where if I want to take notes, I just write notes.
That's just
and
ongoing.
delete. Yeah, this is long-term notes, short-term notes. I regularly delete notes as well. So I like to write a lot. Eventually, if they're unformed notes, they should go to an email
Yeah.
or a Google Doc and get circulated to a wider audience. So I like writing a lot.
Got it. And like this was work. What's the personal routine look like? You told me you start very early and your day starts at like 6:37 for work.
So I like when I wake up, like I like to start working then. So between 6:30 and 7, I'll work for about an hour, but I'm walking at that point of time.
Okay.
So I'm thinking, walking, jotting down notes, sending out emails, messages, whatever. That 1 hour is very productive for
Yeah.
me to reflect back on the past day, on the problem statement that are going on, everything, right? Form views. Then kind of get ready, go to office, but because you have done a lot in that 1 hour and sometimes send out emails and messages, right? The activity
Yeah.
kicks off. Then you have day off, planned meetings, unplanned meetings, whatever, right? You are there throughout the day and then back home.
Yeah. And the rest is very chill.
The rest is?
The rest is chill then throughout the day.
Yeah, so typically when I get back home, children are going to sleep.
Yeah.
Usually whatever wind down I do.
Then throughout, when do you find time to read the 30 odd books that you do every year?
Uh, I'm a very introvert person. I'm a trained extrovert. So I like all my interactions, meetings, meeting people to happen in those 5 days. Saturday, Sundays, I avoid meeting people. So that's the time.
Yeah.
Tuesdays, travel day. So I get a lot of time on
Yeah.
Tuesdays typically. Just before bedtime, sometime I read, or many times I read. If a book is very good, I'll take out time. Sometimes in office, right? A meeting got cancelled. You got free
Yeah,
time.
you've got time.
What do?
Read a book.
Take out your book from your bag and start reading. So enough time to start reading.
Excellent. So one question that a lot of folks from the audience had asked us was that let's say they were starting out now as 20, 21-year-old, what would be best advice that you would give them so that they would get to a place where they are at financial freedom, are independent, and have like a reasonable sized wealth that they can bank upon?
I would recommend them to read or watch Charlie Munger interviews. I think he has cracked that really well.
There's a loss that we lost him just
Yeah,
a few days ago.
very unfortunate, but same thing, right? Spend less than you earn. Whatever you're saving, invest well. Be patient. Compound. Getting the first $100,000 is the hardest. Get there. Whatever, right?
Yeah.
So,
I
following
think-
that guy is the best thing you
Yeah,
can do to.
Poor Charlie's Almanac is.
Yeah, you can read that. But yeah, I'm not the best in this one. I think there are way more qualified people, and I think the best name I can think of is Charlie.
All right. Thank you, Nitin.